Hi, this is Dora DeLellis with ThoughtsOnTheMoney.com. Welcome back to my vlog. Before I get to today's topics, I'd like to make a mention of what's happening in the stock market right now with the sharp increases and decreases in the volatility. If you haven't listened to my vlog session from 2 weeks ago, where I talk about asset diversification, I highly suggest that you do, or read up on asset diversification because it will help you deal with and prepare for future downturns and future volatility so that you can protect your investments. Okay, so today's flashback to 2009 deals with the aftermath of the failure of the big banks and the bailouts that were offered from the government. And I have images of articles from a February 2009 Business Week issue. And last week that I mentioned, in 2009, 10,000 people a day were losing their jobs. And what was also reported in this current issue is the downsizing of industry. Image 1 shows a variety of industries that were expected to feel the burn of the economic meltdown. Because inventories were high and consumerism slowed to a stop, industries that produce goods were likely to continue reducing their workforce. Some of the sectors that were expected to continue dropping employees were apparel production, car, train, and plane productions, and construction. So take a look at images 1 and 2, and I'll be right back. Image 2 reports on the surge of foreclosures and the big banks' response in helping homeowners. The loan modifications offered didn't help, and the think tank of bank executives offered hollow promises. Sadly, most borrowers went into foreclosure or were forced to declare bankruptcy. Based on information that I read last month at the 10-year anniversary, some people reported suffering equity losses that they've never recovered from. I've considered this article so full of information, and it has so much that we can learn from at this point and learning from others' mistakes, that I've reproduced the entire article and put it into my blog post. So take a look at that. Okay, the next topic that I want to discuss is bond laddering. And bonds are sort of the twin of the main investment classes. The first main asset class being stocks. Because of perceived volatility, stocks are considered the evil twin and bonds are the safe twin. I've heard people say, I don't play stocks. And when you think about playing stocks, if someone considers it a game, it's probably not done with any intellect behind it, and it's more like gambling. But where stocks are considered volatile, bonds are the calm alternative. I wrote a bond piece several months ago on my blog, and it was met with some criticism. I emphasized in the blog piece how stocks and bonds move in opposite directions. Therefore, you would want to own bonds to offset stock downturns. My analysis of polar correlation was shot down by those taking into account the latest bond yields that are not in direct opposition to stock market activity, like they usually are. While that may be true, I still like bond instruments for their predictability. So let's talk about that a little bit, and the basics of bonds. When I worked as a tutor, I was helping someone do accounting journal entries for a bond purchaser, and he seemed to be getting confused in what the initial accounting entries were. So here are the basics. The very first entry subsequent to the purchase would be the recording of interest income. Very simply, a bond is a loan or an IOU that pays interest. Interest is the cost of money, and it's a stated amount on the issuance of the bond. So more simply, when someone needs money, they'll ask for a loan, and they'll give you an IOU, which is another way of saying they're offering a bond to another party. So let's say it's a $10,000 loan, and the loaner investor gives the borrower $10,000. In exchange for borrowing the money, the bond issuer or borrower will pay a stated interest rate at frequent interest dates throughout the life of the loan. For accounting purposes, interest income is reported at the interval it's received. So if the $10,000 loan earns 2% on an annual basis, the interest income will be $200 at the end of the year. This is the same as earning interest on a CD. Unless the borrower defaults on the loan, the revenue stream is therefore fairly predictable. You know everything at the beginning of the loan arrangement, and the interest amount is earned when according to schedule. So let's look at the types of bond instruments. Money markets are mutual funds that invest in short-term debt instruments, very similar to a bond. However, they're not issued by the federal government. CDs work in the same way that bonds do, but they're issued by banks or credit unions, and they're insured by the FDIC. Bonds are debt instruments either issued by a government institution or a corporation. Bond laddering is a certain type of investment strategy accomplished by purchasing bonds with staggered maturity dates. It's a way to plan interest income on a scheduled basis, and it's also a way to protect wealth. When a bond matures, the principal can be reinvested in another bond with a maturity date that ends after the last bond on the schedule. So here are some reasons for creating a bond ladder. You looking for wealth preservation when you purchase bonds as opposed to stocks. When you purchase stocks, you're looking for wealth accumulation and growth on investment. So with bonds, there's less emphasis on growth. There's also no surprises. There are predictable income streams, and everything is stated at the beginning of the bond issuance. And like I said earlier, unless there's a default by the issuer, the income stream is very predictable. Laddering helps to avoid being locked into an interest rate. So when different bonds are purchased with varying interest rates, it avoids being locked into one interest rate for the entire investment for a prolonged amount of period. And if the bonds are held to maturity, no loss of principal occurs, like I said, unless the borrower goes into default. So let's look at the reasons against. The opposition feels that bond laddering does lock an investor into an interest rate. Even though there are multiple bonds in the portfolio, some seem to think it does create this interest rate lockup. Alternative products can be used, such as CDs, corporate bonds, municipal bonds, etc. And I've read opposing thoughts on bond laddering, where the recommendation is to use a bond fund instead. Okay, so let's move on to today's second topic. I want to talk about extreme money scripts. And in a recent vlog post, I talked about the first 5 most common. This is the second list of the most common. So the first on that list is a money script that indicates to the believer that there will always be enough money. And here's the ultimate in being irresponsible. The people that tell themselves this lie spend recklessly, bury their heads in the sand, and throw their money away on credit card interest and fees while flaunting their consumerism. Entitlement also has a role in this, and individuals that grew up with everything falling into their hands live by this thinking. Another money script is that money is unimportant. This inner dialogue is another version of irresponsibility. By taking a dismissive attitude towards money, they justify their lack of planning and poor financial decision making. The next is money will give me meaning. People that live with this frame of mind develop a judgment of others based on how much money they think or perceive that another person has. They also believe that by boasting about their own amount of money or possessions, they are impressing others and deserve respect. While their behavior leans toward judging people by money, they will claim that they have deep non-monetary values, which is in direct conflict with their typical behavior. Another extreme money script is that it's not nice or necessary to talk about money. It was reported last year that people would rather talk about their sexually transmitted diseases than discuss their money issues. This is so unfortunate, and there's so much secrecy and sensitivity surrounding money that no one talks about it. Debt levels and spending levels are an embarrassment for some Therefore, they won't pursue information or ask questions. The last one is, if you're good, the universe will supply all your needs. The research indicates that those with religious beliefs buy into this assumption. And I'm not knocking anyone's religious beliefs, but those that are waiting for the universe to drop money down on them will be waiting a very long time. So again, do you hear yourself saying any of these statements to yourself? If you are, they could be avoidance mechanisms that will deprive you of good decision making. It's better to be realistic than to pretend that money isn't important when it is. So join me next time when I discuss how interest rate increases affect your life and reasons to have a will. Again, please leave feedback and questions on thoughtsonthemoney.com, and I'll see you next time.